Do you remember how excited you've been when you started your business? You could do nothing but talk about your ideas. You had a vision for the future, you talked about your friends and your family, you were excited by the prospect of not having to work for anybody but be your own boss. And yes, once in a while there was the question of how do you fund your business, and maybe initially you even spoke to a bank and they told you that, well, to get a loan, you probably first need to have a little bit of a track record. So if you come back in 6 months and we look at how your business is doing at that point, maybe then we can give you a loan. And so you started to use your assets and you burned through them, because we all make mistakes when we start our business. And then maybe you borrowed a little bit of money from friends and families and you burned through that as well. But eventually you figured out how to do business. And eventually you figured out how it all becomes profitable for you. And suddenly that question reappears. The question, how do I fund the business? Because now you want to take the next step. Now you want to bring your business to the next level. And yes, the bank is on the cards again, because now you do have a track record and it's probably likely that you are eligible for a loan. But then you also hear about venture capital, you hear about the advantages of having equity in your business, and so you start to wonder what is best for me. In this video we look at both the equity and the debt financing. We look at advantages and disadvantages of both options, and we will also look at a way of how you can structure your thinking to determine which one's best for you.
I have a dream, that's all I need. I'll make it happen with some work and belief.
Hello everyone, my name is Leifert. I spent over 20 years in the financial industry, and in that time I learned a thing or two about financing. And in today's video we specifically look at equity versus debt and the advantages and disadvantages of both. The thing about that is that typically it is easier to obtain. You don't have to have the same level of discussion, the same level of due diligence that, for example, you would have to do when you look for equity financing. All you do is you reveal the business plan and your thoughts and your financials to a bank or to a company such as Funding Circle, and they will make a decision based on that. On the other hand, if you look at equity, well, the advantage is that you will have a partner who is far more interested in the success of your business, which typically for a bank that's not really the case. They want to make sure that you repay them, but apart from that and beyond that, there's very little interest. But with an equity partner, you have somebody who is now engaged with you. But the price you pay for that is a lot more discussions, a lot more due diligence about your business. With that, the other thing that will help you is your personal credit history. If you have a very good credit score, it'll be very easy to obtain credit for your business as well. Because typically the banks will always have a clause in their statement that when the company can't repay the debt, that you personally will be liable. The advantage of equity on the other side is that it is truly a limited liability. You get equity into the company, and even if things go wrong, then that is all that you can lose. Let's look at something fairly obvious. If you look at debt, then you retain far more control over your company because you're not giving away any ownership of it. On the equity side, on the other hand, it allows you to leverage those investors, to get their ideas, to get their connections as well. If you look at the financial side, the advantage of debt is that the interest that you pay is tax deductible. And obviously that's not the case for equity. However, what is the case for equity is that after the transaction, your balance sheet will look a lot better than if you had piled up debt. And the final thing to mention is that with that, you have a very short-term solution. You have an immediate need for cash, and so the loan tides you over. On the equity side, you have far longer-term implications. For those of you who have watched this channel for quite a while, you'll notice that we have a very different backdrop today. Main reason is that, number one, I wanted to change things up, but also it is a bit of a transition towards another backdrop that you'll probably see in a couple of weeks. Regardless of that, let me know in the comment section below which one do you prefer. Is it this one or is it the one with the bookshelf? Now then, what should you do after we figured out those advantages and disadvantages of equity and debt financing? In order to do that, let's look at a simple flowchart. And the first question I would ask is it sensible to bring in more money into the company? I've asked the same question in the funding circle video as well, and it is important that you are very clear what you will do with the money. Is it truly there to increase your profits in the future or to make things better in some shape or form? Or is it something that tides you over in a crisis such as the 2020 pandemic? And if that is the case, just make sure that the business model for the future is still valid. Now then, let's assume that it is sensible that you bring in more money. Then the question becomes, is it urgent or is it non-urgent? Because quite frankly, if there is an urgent need for cash, debt is probably the easiest way to go for. It is much simpler to obtain, and let's be honest, even if you take on debt, you can still go and look for equity investors afterwards and then convert that debt into equity. Now, what if you have a little bit of time to decide? Well, then the most important question to ask is, what does your investor bring to the table? In an ideal world, it is not only the cash that they bring to the table. Make sure, for example, that they have industry connections. Maybe they can introduce you to new clients. Maybe they can help you to improve a product. Maybe they have connections to a supplier of yours, so in the end it might be cheaper for you to obtain some of the raw materials that you use. And if the answer to any of those questions is yes, that particular investor helps me to grow my business as well, then definitely go for equity. So what if that is not the case? If that investor doesn't bring you new clients or a different product or a cheaper supply chain? Well, there are still a couple of considerations to make. And one of them has to do with your personal risk appetite. Are you willing to go to a bank and get a loan, even if it means that it might impact your personal finances, your personal wealth? And if that isn't the case, then the best option for you might be to give a little bit away of equity, bring in the investor and have the truly limited liability. But if that is also not the case and you are truly believing in both your business and your product and you know that you can do it without an investor, then by all means go for debt. If you now wish to delve deeper into the subject of either equity or debt financing, then I'll invite you to watch one of the two videos that are on the screen right now. So I will see you over there and otherwise in the next video.